Guys, today it's May 15th, 6 a.m. Yeah, I generally walk and it's super cold here, but I just saw a post by one of my friend in India. He just posted what are the master class which people might be super interested to take, and the one which had highest votes was financial planning. That had the highest vote, most of the people wanted that. So I thought about it and said, let me make a video about it. Like, people are willing to pay to get that knowledge, why not make a pay free version of this? So financial planning, right? Like, most of the time you earn money, and then that is one way of earning, right? Like, you are working for a company, or you have your own company, you are making uh, amount income, and that income you can either put in the bank, right? And then if you put it in the bank, then it will create some interest. And while the interest is good, right now interests are not that great, uh, better than last year, but not very good. In US I'm talking about, earlier it used to be like 1%, something like that. From last year the interest rates have spiked a lot. Like, most of the banks give like 5-6% APR per annum, right? And even in India, earlier, uh, the SB account, right, savings bank account, if you keep your money, it wouldn't be like 20-30%, around 7-8% or something like that. So that is one way of earning money. You make money, keep in bank, you create interest, using that you take care of your some expenses. But that's not a very good approach to go about. The other way is you invest in uh, home, buying a home or a land. So buying a home, most people think is a great asset, but I have a theory, although it is a asset, great asset, but over time, like if it's your primary residence, over time, the same amount, had you invested it in some other form, like stocks, or say land, just land, not home, just like residential land, right, like plot, or that will appreciate much higher than your home. The reason being, you would take a land plot, and you construct your home, right? Once you construct your home, then the appreciation won't be like as good as barren land, because if it's empty land, somebody else can build their dream house there. But if you already built, then the other guy has to demolish it, unless he likes the exact way you have built. Most likely people don't like it, so so then it's demolition cost, then so it won't get a good valuation, in my opinion. So barren, like just empty land, it's good. Or if you invest it in stock market, like when it comes to stock market, I'm not a investment advisor or anything. What I have done, I'm telling, okay? You should consult your CPAs or tax planning guys. For this is only educational. So from my point, what I many think investing in stock market is losing money. like this is a very tough question to answer, but the way I look at it is if you don't want to, like, completely 100% sure that you don't lose, like, let me rephrase my thoughts. Warren Buffett said investment, there are two rules of investment. One, don't lose money. Rule number two, don't forget rule number one. Okay, that being said, the intent is to never lose money in investment. That's the intent. But if you just check 2024 Berkshire Hathaway annual meeting, they said they lost so much money on Paramount. Paramount as a TV company, right? They lost a plenty of money. So they have these rules. He set them like he's a proponent of those rules, and they mentioned in the all hands, we made a mistake and we lost a lot of money. This is similar to what he mentioned. So even the likes of Warren Buffett can sometimes make a wrong investment, or like when they were making the investment, right, something else was in play. Like they saw all the good things, potentials, and they made a investment. So at that point, if he wouldn't talk about any of his investment, if you say why did you buy that stock, he will never tell you. But if you have to go into his brain or mind, read him, then he would give you all the positive reasoning why he made that decision at that point of time. But then the market dynamics change, many things come into play, like there were many competitors came, like Netflix, all that. So their monopoly, or the what you call, like their huge advantage, the Paramount as a TV provider, it went down. And then the things changed. So however good you might be as a investment like stock allocator or capital allocator, you tend to make some mistakes some point in time. So that's given. So the reason I told that is, like you might make mistakes in investment and you might lose. So to protect yourself, what if you don't want to lose at all, then you better keep your money in bank account and FDIC insured, or some insured, and you'll get little interest. Use it. That is one way of going about it. Or invest in mutual funds. What mutual funds has a very missed meaning in India, like, because the reason because lot of the investments in mutual funds in India are sold by banks, and these banks have a heavy incentive to sell them. Basically, if you invest 100 rupees, or even in any country, right, $100 or whatever, how much is actually going into that investment matters a lot. If there is lot of expenses for that mutual fund, then it's not good. So what I realized, like 10-15 years ago, when my family took some loan, the banks, I won't say the banks and all, but the banks forced us to take some mutual funds. We took it, 1 lakh worth or something, and then after some years it just evaporated, no value in that. The reason like that I realized way later in when I came here, that those investment had heavy expenses. Like out of 1 lakh, hardly 30-40,000 was invested in the actual fund. All the 60,000 went into the commission, all these sort of things. So, and then 10,000, 40,000, and what time was that 40,000, and what were the underlying stocks. Basically, whenever you buy mutual fund, right, even they invest in stocks or bonds or something like that. So if they, example, imagine it was 2007 or something when my family brought this, and that time the market was boom and everything was 4x, like very very costly. That time we brought a 40, like 1 lakh worth mutual fund, but the actual amount which went into the mutual fund is just 40,000. So 40,000 we got some stock, and suddenly 2008 recession happened, right? Like then that value dropped to like say 25% or something, or 10% for that matter. So your 40,000 either became 10,000 rupees or 2,500. Now as soon as it dropped, and then over a period of time it either appreciated. I didn't pay attention what happened to that after that. But what I'm trying to tell you is, whenever we are investing any mutual funds, we should be very careful of expenses. If somebody tries to sell you some mutual funds, you should ask him, hey, if I invest 100 rupees, how much will go exactly into the fund and how much is the expense? Many will not tell you, hey, I have to check, so if they are not telling, then you should not invest. Basically that means it has a loss of expenses. So yeah, that is with mutual fund. For mutual fund, there will be, yeah, how much is going into the fund, like 40,000 in my example, right? And then there is a expense ratio, like to manage that 40,000 there will be fund managers, investment bankers, all that. So their salaries has to be paid. So what they will do is, like 40,000 there are 10 people, 4 lakh, like that 100 people, 40 lakh. So for 40 lakh there will be like 2-3 fund manager. Their job is to is to select which funds, which shares these funds should go. So now they have to be paid, and these fund managers are pretty expensive. And then they example, if they for 40 lakh, if the fund manager is paid say 10 lakhs, then only 30 lakh is remaining. So out of 40,000, 10,000 gone, everybody's, only 30,000 is there, right? Now that 30,000 he invest, or even he might make the money after the return, we don't know. But that expense ratio is important. So in here in US there is something called as Vanguard mutual funds, and basically they are S&P 500 funds, and most of the time the expense ratio is very low. Yeah, it's as low as like 1%, 2%, very less. And in one of the Warren Buffett stocks, he was asked, or in his shareholder letter he mentions, like, what will he suggest his family to do after he is gone. He said, I'll ask my widow wife to just put her money in some S&P 500 stocks, because trading stock is very difficult. So I'll tell her, and with that, it's self-cleansing. That's what they call for mutual funds, self-cleansing, in the sense you put the money in, and if that company in which that mutual fund invests their stock or their money, if it appreciates, they put more into that stock. If it depreciates, like if it goes out of S&P 500 or it value erodes, then they will just keep removing those companies from their funds. So that means every time you don't have to do the thinking. So, and the earning potential will be similar to what S&P 500 will do. Like example, if the share market is growing at a rate of like 7-8% cumulatively, because these funds invest in all of the companies, small chunks, so it will grow. And here there is a fund manager, so they will try to do a little bit of optimization, and not too much, a very slight percentage of optimization. In Vanguard case, I think they use mostly algorithms and all that stuff, I don't know, but they will do some optimization. So when they do that, so you will get a better earning than S&P 500. That is the point. That is, like, if you are super scared of investing in stock, then you should explore investing in some Vanguard funds. And these Vanguard, some of these, like the ticker symbol is VOO, VOG, VTI. You might want to check in your trading accounts what are those. And I think I should have explained about some like, first of all, you have to invest in your PF, like if it's there in India, right, provident fund, you should maximize this. And whatever retirement options they give at your company, you should use all that. After that you come to stocks. Until that, don't come to stocks. And if you have loan, then even don't think about coming to stock market. First pay your loans, completely pay off them, and then think of investment. Okay, so you funded your PF, your retirement, 401k, you funded your IRAs, you funded your Roth IRA, all that, and then still you have money. Then you come to mutual funds, and after mutual fund, if you want to try a little bit further, you want more returns, maybe then you do deep research on any particular company, right? And based on your research, if you feel this particular stock might grow, then there is something called as true value of any company, right? Like if you are buying a stock when everybody is talking about, that means it's already very expensive, so that's not the time to buy. Like example, if you are buying a TV, or you want to buy a refrigerator, what you will do? You will wait until there is a deal, right? Like Deepavali or some Thanksgiving, Black Friday, some time you will wait. Unless if you are in rush, like if it's essential, then you just go and buy, that is different. But if you have a high purchase like a car or a TV or some equipment, generally what we do is we'll wait and let the price drop. Similarly, if you come down, if you make some research and come down with one or two stocks, and then you check whether that stock is undervalued or overvalued. If it overvalued, then you don't invest that time, you just wait. And as soon as some market dynamics change, like there is some news, and because of that stock starts falling or something, but your research, whatever you do, if it still holds good, that's the time you will go invest in that stock. And there also you can do in smaller format, like 100 rupees, $100, like that. So we talked about bank account interest earning. Then we talked about mutual funds, which is in a way good for most of the people, because you don't want to get stressed out. So just invest in mutual funds which are lowest expense ratios, ER, that's what they call. And the final one is stock, right? And stock you have to just buy when you, after you do enough research, not just listen to somebody and say, hey, which stock should I buy, tell me. Then he will say buy this, then you will buy. But he won't tell you when to sell, and even he don't know when to sell, because you can't ever tell what is the maximum peak or the bottom of any stock. So he will have his own assumptions, or he might say, if I make 10% I will sell, if I make 20% more I will sell. But what is your number, that only you can tell, right? So if you are listening to somebody else for stock picking, then that might not go very well. And yeah, I think this I'll stop at this. Maybe I'll do one more video, maybe if there are some comments, and see and answer them in the next video. Bye for now.